In this video, I'm going to break down options so simply a fifth grade can understand. Go figure. I used to teach elementary school for over 15 years. All right, guys, so make sure you have your pen and paper because note takers are money makers. I'm going to make it very simple. A lot of people try to make options sound like rocket science, but that's not my goal here. Simplicity is key when learning something new, so you know I got you. All right, so let's get right into it. What are options? Options are simply the right, not the obligation to buy or sell a specific stock. All right. And when it comes to options, guys, we are not owning that company. We have, like I said, the right to buy or sell these contracts by a certain time. Okay. So put that separately. The next part I want to talk about in regards to options is that you have two types of options that you are going to be trying to purchase, right? The first one is going to be a call. And when you are looking to purchase a call, for example, in Apple, you believe the price or the stock value is going to go up. So I like to say when you're thinking about call, you pick up the phone to make a call, right? Pick up the phone. The second type of option that you're looking to purchase is going to be a put. When you purchase a put, you believe that the stock prices or the value of that stock is going to go down. So when you're finished on the phone, you put down the phone, okay? So we have a call and we have puts. So this is exactly why I really like options, my friends, is because you can make money in the stock market if the price of the stock goes up or if the stock prices go down. All right. So let me give you another quick new vocabulary word. 2. If you hear someone says they're going to go long, that's equivalent to a call. Or if you hear them say, I'm going to go short or we're going to short the stock, that means you're going to go in a put position. All right, you're doing great. Let's go to the next thing. You will need a brokerage. What is a brokerage? Think of it as a bank. This is where you'll actually be able to give your physical cash to this third-party company, and that is how you're able to execute trades, okay? So a few of the brokerages that I have used are Webull, Thinkorswim by Charles Schwab, and Robinhood for a short period of time. I currently use Thinkorswim by Charles Schwab, okay? And if you're brand new to trading, I suggest you pick a brokerage, and this is just my opinion. I suggest you pick a brokerage that, 1, you can use easily, and 2, has the paper trading feature, okay? What the paper trading feature does, my friends, is it gives you the opportunity to practice using that software or that platform while the market is open without investing your real money. So think of it as you get monopoly money to get a feel of not only what the brokerage, how it lets you enter and exit a trade, but what it feels like to trade when the market is open, right? You see the candlesticks moving, you get like a real world experience, but you get to safeguard your finances or your money until you're comfortable with the platform. So let's go on to the next thing. All right, so I get this question often. How do I place a trade? So your options chain, your brokerages, remember that's how you place a trade. They all have an option chain, all of them, right? And think of an option chain as a menu. And there's some important parts of an options chain that we're going to break down right now. So one of the parts are going to be obviously a call or a put. Remember, we talked about that earlier, right? If you believe that the price is going to go up, you would purchase a call. If you believe it's going to go down, you would purchase a put. The next part is going to be your strike prices. So your strike prices are where you believe that the price of that particular stock is going to go up. So if you're believing that Apple is going to go up, you're going to purchase a call strike price. Or if you believe it's going to go down, you're going to purchase a put strike price. The next part of the option chain that I want to point out is your premiums, right? You're going to hear this word. The premiums are the cost that you have to pay in order to purchase that strike price contract, right? Or that strike price or that particular option. So the premium is actually what you pay out of pocket to get that contract, all right? Last but not least, when it comes to options, we have an expiration date. Think of it as if you got a Starbucks coupon. I just had Starbucks, so it's fresh on my mind, right? If you get a Starbucks coupon, it has an expiration date. You have to use this coupon by this expiration date or it will expire worthless. Okay, so our contracts or our option contracts are tied to an expiration date, my friends. That simply means you need to exercise the right to use that contract before it expires worthless. So those are the important parts of an option chain. They may look different in regards to each brokerage, but each brokerage has one, and that is how you're able to actually enter into a trade. All right, y'all. So you're going to need some sort of charting platform, some sort of area where you can see the candlesticks and see price action. So I personally use tradingview.com as my charting platform, where I'm able to analyze the charts. I'm actually able to look at price action and get a read of what the particular stock is doing and determine off of what the candlesticks are doing to get into a trade or get out of a trade. Okay, so listen, all charting platforms, they're, it's preference, right? Preference, but you need to look at the charts, my friends, and actually that is how you're going to be able to know how to get in and out of a trade. Okay. All right, y'all. Let's talk about the anatomy of a candlestick. Okay. So the candlestick, make sure you're writing these down. The candlesticks, they have 4 important parts. They have the open price, the close price, the high, and the low. All right. So all candlesticks are giving you is a visual of what price is doing during that time period on that particular stock. It's literally just a drawing. Right? So just think of them as candlesticks, right? And the red candlestick is going to be considered a bearish candlestick, and the green candlestick is where they call them a bullish candlestick. All right? So when you are looking at the charts, I do not want you to get scared. They're just candlesticks. Say with me, they're just candlesticks. And all they're doing is stacking up the candlesticks side by side and giving us a visual of what the price is doing during that time period. Okay? So when you look at my chart, right? This is all that it is. It's just showing you that price went to this point. That was the high, the low. This is the body, okay? And then it's just giving you a visual that we can see over time what price did during that particular time period. All right, so I just talked about bulls and bears. I want to give you a little bit more detail on that, okay? So you might hear something that they say is a bullish market is bearish market. So think about a bull in nature. They have horns, right? Ole, right? So bulls strike up. So when you hear of a bullish market or a bullish candle, we're thinking about green, up, 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 bull up, right? Now, contrary to that, if you hear it's a bearish market or it's a bearish trend or it's a bearish candle, when you think about a bear, they go roar, they strike down. So bears are the red and bulls are the green, okay? So that's simply what it is. When I figured that out, it was really cool to me. So I hope it made sense to you. All right, let's talk about trend, okay? There's 3 types of trend in the market, and I'm going to show you about the 2 that we trade in, right? So the first type of trend that we trade in is going to be an uptrend, right? You see this image right here. This is what an uptrend looks like. And an uptrend is simply a series of higher highs, higher lows, and higher highs. Just think of it as a staircase or like a mountain, like you're climbing up a mountain, okay? The second trend that we like to trade in is a downtrend. Look at this image right here, right? And a downtrend, we are looking for a series of lower highs, lower lows, and lower highs. So think of it like an escalator going down or a staircase going down. Now let's talk about what we don't trade in. We don't trade in a choppy market or a sideways trend. Look at this image right here. Sideways is no clear direction, and this is where you get literally chopped up like a chopped salad, and you don't want to deal with that. So remember the 2 type of trends we trade in: uptrend and a downtrend, no sideways trend. The technical term for a sideways trend is either accumulation or consolidation. All right, so let's talk about support and resistance. So support and resistance is for levels or critical levels on the particular chart or in this particular area where buyers and sellers are hanging out, okay? So what we like to do in regards to when we're trading is to make sure we're aware of these support and resistance levels, okay? So in case you're in a trade, you will know or you'll have an idea of where the buyers and sellers are hanging out, and price may react. When I mean react, it may bounce, it may break through, but it's better to be safe than sorry. So as a trader, making sure that we have support and resistance levels or critical levels marked on our chart is super, super important to your success as a trader. So support and resistance, make sure you have that as a part of your strategy. Support is going to be wherever you are right now, my friends, you have a floor beneath you. So support will be considered a floor, okay? So if price is bouncing on this particular level, right, and cannot break through, that level is considered support, okay? Now, contrary to support, we have what we call resistance. Resistance is going to be a ceiling wherever you are right now. If you threw a tennis ball up, it would more likely bounce down. So in this case, if there's a level above price action and it has bounced here before, this level that price has bounced at or touched and reacted before is called resistance. So knowing where support is important and knowing where resistance is important, because if you're interested in a put play, you would know where support has been before. And if you're interested in a call play, you'll be aware of where resistance has been before. Trading needs to be simple. It should be simple. You need a simple strategy that you can follow day in, day out, and use it on any ticker symbol. So my friends, if you're looking for a simple strategy that you're able to follow on a daily basis and also be able to see my screen and trade with me live, all you need to do is comment the word Discord or simply click the link in the description box. All right, guys, make sure you give me a thumbs up and subscribe to this channel because I'm going to do more videos like this. And don't forget to write something in the comments because I love reading my comments and hearing from y'all guys. All right. So I hope you have a wonderful rest of the day. See you.